philosophy is kind of just keep it simple. Don't overcomplicate things, right? You can't control what the market's going to do, but you can control how you react to short-term headlines. It's definitely planning based first, right? So we're going to look at the plan, build the plan, and then backfill with the investments. Most clients don't fail with their plans. They pick the wrong fund or the wrong investment. They fail because they don't have the disciplined decision framework around picking those investments.
And you said that you start with the planning part of it. It sounds like there's a lot of technology involved.
On the planning side, we use software to build up those financial plans. So we use a company called Right Capital. They run the Monte Carlo simulation. They look at 1,000 different sequence of returns to see if, based on what we're recommending, does it work, right? What's the success rate on these 1,000 trials and these plans? And so there's definitely technology behind financial planning software, but then it comes back down to the human element. Somebody's got to be able to look at those numbers, make sure they make sense.
At this point, you've been successful in it for a long time. You own your own firm. What's driving you? Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Chad Taylor. Chad began his financial services career in 1997, soon after graduating from Texas State with a finance degree. And for most of his career, he's worked with large brokerage firms, most recently with UBS Financial Services. And then in 2021, launched your own independent financial services firm and founded Seapoint Wealth Advisors. Chad, thank you so much for coming on the show today. Thanks for taking the time out to chat with me. I'm super excited for the conversation.
Yeah, Jason, of course. Thank you for having me. I appreciate it.
Absolutely. Let's start just hearing about you, hear about your background, kind of what got you to where you are today, and then we'll dive in from there.
Yeah, well, I've been interested in finance since I was a little kid. I grew up outside Omaha, Nebraska, a little, 900 square foot house, 3 bedrooms, 1 bath, mom, dad, and a sister, and lower income, middle class, I'd say. But I just knew at that point I didn't want to grow up that way. I remember wanting to learn about money and how to save and build up wealth, because not having it makes you want it, right? And so I remember as a senior in high school, we're playing for like basketball, and the Nike had an agreement with our team to come out and get us new sneakers for the team, and it cost like $150 for these new sneakers, and I was the only kid on the team that couldn't afford the new sneakers. And it was fine. I didn't resent my parents for doing that, but I said at that point, I want to learn about money. And so from that point on, my focus was on learning about finance and financial planning and money. And so that's kind of how I got into it. As you mentioned, I ended up playing football in college, had shoulder injuries and wanted to, continue my education and just focus on education at that point, since I couldn't really play anymore. And got a finance degree from Southwest Texas State, which you said, which is also now Texas State University. And was very fortunate from that point to get my first entry with Merrill Lynch in Dallas, Texas. And the lady I worked for back then, she was at that time like a top 20 advisor for Merrill Lynch, and I think in the top 5 or 10 female advisors for Merrill Lynch at that time. And for me, starting out in the business, being 23 years old, coming from somebody who didn't have anything and no family connections to kind of get in this business, she helped me. She was kind of like my mentor when I started in this business. And without her, I never would have made it. I essentially got my MBA in financial planning by working with her, teaching me about how you build portfolios, how you build an asset allocation, how you work with your clients, how you take care of your clients. And so that's kind of how I got into it, and how I kind of got started in the business is kind of growing up and wanting more.
I would loosely say that's how I got interested in investing too. As you're telling this story, I was the kid who couldn't afford the sneakers, so it was. Yeah. I learned at a young age that let's figure out how to make some money and not be in that position later in life. So I get that. So when you start in that field and you were working for Merrill Lynch, you said that this woman acted like a mentor and kind of taught you how to get clients, how to treat clients, how to take care of them, all of that. maybe talk a little bit about that, because it sounds like you were young
Yeah.
at the time when you were in that position. So how I think this is something relevant to a lot of people just coming into well, I guess really any career, but in a lot of ways that this is essentially sales in the sense that you're trying to get customers to trust you to be a good steward of their money. So how do you approach that? How what are some of the lessons that she taught you?
Yeah, I mean, it's tough, right? You're 23 years old, you just graduated from college, and you're going to ask somebody to trust you with their retirement savings, right? And they're not going to do that. I mean, you got a few that'll take a chance with you, right? But that's why the failure rate in this business coming out of college is like 90%. Most guys don't make it through the first 3 years, and um, and so having her there to kind of teach me the business, and somebody that if I had a client that wanted to work with me, it wasn't just me as a 23-year-old kid out of college who knows
Yeah.
not to be dangerous about managing finances. I had, her name is Dodie. I had Dodie would sit down with me and the client and say, look, he's part of this team. We're going to help him build this portfolio. And you're not just coming in and working with Chad, you're working with our group, right? So it adds some credibility to you as you're trying to get those new clients. But even still, it's a very tough business to break into. And without her, I would have been one of those 90% failure rates. But because of her and her reputation, she was able to help me get in front of clients and teach me, go work with his law firm, and you get to work with one of the associate attorneys, and maybe work with the second associate attorney, and then let them know that we're all working as a group, and you kind of go out there and build your reputation that way. And that's kind of what she did. And like I said, as a 23-year-old, because I got guys trying to kind of join our firm right now, right out of college, and I try to tell them the same story that she taught me is, as a 23-year-old, it's tough. I mean, your friends might give you your money to manage, but going to talk to somebody who's getting ready to retire, and they're looking at you as a 23-year-old kid who's never been through a tough market, and we're going to trust you with our retirement savings and building our plan to get us through retirement. And it's just a tough business to break into that way.
Yeah. Yeah, it makes total sense. And I think that, I mean, we talk a lot about mentorship on this podcast, and it's been really instrumental for me. And I think like a lot of the success stories like yourself just come from that place. You've got someone who was kind of there to teach you the ropes, and the piece about like, oh, Chad's a part of the team.
Right.
You're not just trusting this 23-year-old kid from the street. Like, yeah, I mean, the reality is you could have someone who's 23 who's like brilliant and really knows how to do things well, but that may not be the perception from these clients.
Yep.
So you work in that space, you kind of, have help bringing them in. And I would imagine over the years, you build up that trust. And you said,
Yeah.
you get one associate in the law firm that you do well with them, they might refer you. So I would assume that's kind of how the growth strategy would be, like a referral standpoint. How do you then maybe go from being that junior member of the team to now you own your own firm and kind of built up that way?
Yeah. I mean, my manager back there when I launched, a guy named Jim Svinstrup, was awesome. Really good manager. But I sit down and talk with him, and I don't remember but he would call me and the rest of the new guys. We were competently incompetent, right? So you're competent, but you're incompetent because you don't know what you're doing. And I mean, it takes a good 5 to 7 years, I would say, where you can sit down and now you run your own meetings. That the questions that get asked that people have, you know an answer for it, right? Where now all of a sudden you are not that junior person anymore. You're 7 years in the business. You've maybe been through a bear market where now you know how to handle a bear market and how clients react during that bear market. And when a client comes in, they don't see you as a fresh faced kid out of college who's just now learning the business. You got 7 years of experience behind you, to where they will sit down with you and kind of trust you more with those portfolios and building out the allocation. And so I think at that 7 year mark, 5 to 7 year mark, is when you can start kind of feeling that transition, because it's about confidence too, right? You come in and you might think you know what you're doing, but you're really not confident. Well, after 5 to 7 years, you brought in a few new clients on your own, and you built that plan. You've taken them through a bear market, and you've done your reviews with them, and you start yielding a little bit of confidence to, when you're talking to somebody, it comes across your confident. Now, when you're going out there and trying to attract new clients, that confidence comes across too as you're meeting with them, right? You're not saying I'm just part of a team. You're standing as your own, knowing the team's still back there. And I think that, like I said, because after the 5 year mark too, if you've made it through 5 years, the success rate drop, is closer to 40 to 50% at that point. So you've made it now past that failure rate, where you've got a little bit of a career that's going the right direction. And so I think, like I said, at that point, your confidence kind of comes in a little bit, and then as you go, it's just like anything else, right? It's the experience. You've seen how the market reacts, and the market pulls back, and you have volatility, and how that affects the financial plan. And a client who's now retired and taking money out of the portfolio, but we just had a bear market of 20%, and how does that affect the portfolio and the withdrawal rates and their feeling, right? Because they're not working anymore and they're not replacing that income. Well, how did you react to that for that client? How did you walk them through that? How did you guide them through that bear market? And so all those experiences start to kind of build up and kind of guide your career to now, when this comes up again, you're confident you can handle those situations.
Yeah.
And that attracts more clients.
Are you planning a remodel or construction project? Overwhelmed by the process? Over budget? Extended timelines? Strained relationships? We are all too familiar. At Lark Construction Services, we help homeowners and business owners take control of their construction journey, from reviewing bids and contracts to catching red flags before they become costly mistakes. Our Clarity Audit is a one-on-one expert review of your plans, estimates, or current progress, giving you the peace of mind and a defined action plan to move forward with confidence. Don't let confusion lead to costly errors. Visit larkconstruction.com and schedule your free call today. Lark Construction Services, saving you time, money, and stress.
That makes total sense. I mean, the 10,000 hour thing, coming from, I think the book is Outliers, but the Malcolm Gladwell book, it's real. And I mean, and ultimately, like 5 years, if you're working 50, 40-hour weeks, like that's a 2,000 hours a year. Like 5 years is about that time where you can maybe start to look at yourself as an expert in that particular subject. And then you just mentioned the confidence that comes with that. Now you feel good about what you're doing. Your clients they're going to read that. They're going to start to understand, that, okay, this guy really does kind of understand what they're talking about. You can speak to them probably more fluidly, more intelligently about, what exactly it is you can, what service you can provide for them. And so, it makes so much sense that is, sort of the time frame, and I would imagine, but it's hard to be incompetent. I guess it's hard to feel that way for an extended period of time. It's hard to say, oh, I'm going to put in these 3, 5, 7 years so that then I am, at the level that you're at, at that point. What so that was, you did that 5, 7 years. What brought you to the point of feeling like you wanted to go off on your own and have your own firm?
Yeah. So, gosh, at that point, 2021, I've been doing this for, I can't do the math, 23, 24 years. And I was confident, right? I had experience. I worked at that point. I think we were managing about 220 million of assets at that point. I had a really good group of clients I worked with that I got referrals from. And, I kind of built my business around clients I enjoy working with too. So my clients are people I enjoy talking to and working with, and we have good relationships. And, I just noticed, which had been this way for a long time, but I just know the bigger firms at that point were becoming a lot more kind of product driven. It wasn't so much about the building right portfolio or allocation of the client and guiding them through. It's like, look, if you sell a mortgage, we'll increase your pay by this much, and we'll give you more of a deferred comp. And that's, to me, that's not why you make decisions for a client, right? You're not making that decision for a client to do a mortgage so you get better comp. And that was, it's always been that way, but every year you get a new comp package, and it's like, okay, if we do this, then you get this level of pay versus, this level of pay. Um, and the big firms at one point was dominant for like all the information you get for research and tools to help build out portfolios, and that had all changed. And the independent firms were actually would have more information that was available for clients because it wasn't you had to use UBS's information or Morgan Stanley's information. You can go out and use you know um, you know Fidelity's or T. Rowe Price, and so you have all these different resources you could use that were available to you. And at that time period, there were some changes at UBS going on where they were basically kind of taking ownership of your book based off deferred comp and making you sign non-compete clauses every year to get your deferred comp payment. And I just saw the direction it was going, and I said, look, I've been doing this for 24 years. I got a good group of clients I work with, and I want to own my own practice. I want to own it. I want to be able to run it the way I want to run it. I want to make sure, when I'm working with clients, I'm using the right investment for them based on, what's right now versus what the comp package is. And that's when I went and really 2020, I went and started researching all these different firms and what they offered and, who could serve us best to kind of build out that practice we wanted. And that's when we, chose LPO as our custodian to launch Seapoint Wealth. Is to be our own guiding light, our own direction on how we wanted to run our client-based practice and take care of our clients.
So that's, the career trajectory is it's a really great demonstration of, kind of mentorship and kind of just sticking with it to reach that level of expertise. Let's kind of switch to talking about kind of how you look at, the way you treat wealth with your clients. How do you, some of the advisory strategies that you use? What's your, I guess, how do you approach, wealth management from a client perspective?
Yeah, it's a little bit different, which, depending on what client you're working with. But,
Sure.
For the most part, my philosophy is kind of just keep it simple. Don't overcomplicate things, right? You can't control what the market's going to do, but you can control how you react to short-term headlines, right?
Mm-hmm.
So when we look at it, it's definitely planning based first, right? So we're going to look at the plan, build the plan, and then backfill with the investments. I find that most clients don't fail with their plans; they pick the wrong fund or the wrong investment. They fail because they don't have the disciplined decision framework around picking those investments and decisions and allocation, right? And
Sure.
So that's what we kind of focus on. And obviously, like keeping it simple, we just use for the most part index funds, ETFs, and mutual funds, and that's the core of our portfolio. We have, fortunately, we've grown this business quite a bit, and now we have a lot more access to different things that are out there. So we use a company called Aladdin, which is owned by BlackRock, to kind of look at our portfolios and manage the risk with them. So they'll take our information, they run through, I think, 1,000 different risk metrics, and it kicks back, okay, based on this situation, you're taking too much risk here or not enough risk here, and here's where you have overlap of the funds. And then once we kind of agree on that framework, we send it to them, and then the team of CFAs, certified financial analysts, that look at it and they look at the investments we're using, and they kick back another layer of information saying, okay, based on what you have here, we might suggest you want to look at this versus this, and so that's what I'd say is our core portfolio, where it's just we're looking at the best products we can find for our clients to fit that allocation we're looking for. And then obviously, if you get a higher net worth, you get a little more complicated situations where you might start looking at like private equity funds or hedging strategies and things like that, where they're a little more illiquid, where you get away from that kind of keep it simple philosophy. But they provide different aspects, right? Like one hedge fund or private equity fund we look at, has access to SpaceX, right? And some of the more risky things that are out there. We have some that are more designed to manage risk, so you get market-like returns, but you don't get it based on what the market's doing. You get it over a time period where you end up in the same spot, but your volatility is a lot lower, right? So, and that's as you build up the plan, the client's, net worth, their liquidity needs, their time frame, and that's where you kind of start adding some more, complex products. But for the most part, the core is just, your ETFs, your index funds, and your mutual funds.
Yeah. And you said that you you start with the planning part of it. It sounds like there's a lot of technology involved. Am I understanding that correctly? That it's sort of in that beginning, I guess, in those beginning phases.
Yeah, there's definitely a lot more technology involved now.
Right.
From like 5 years ago when you look at the allocations, because you used to have a lot to do this stuff manually, right? Now we just upload it to Aladdin, it kicks out in like 20 seconds, and there's artificial intelligence around it that kind of helps him manage it.
Yeah.
So what used to take a week or so takes like I said 20, 30 minutes now. So that's some of the technology. And then of course on the planning side, we use software to build up those financial plans. So we use a company called Right Capital. Right Capital, where it's they run the Monte Carlo simulation where they look at 1,000 different sequence of returns to see if based on what we're recommending does it work, right? Does this plan what's the success rate on these 1,000 trials in these plans? And so there's definitely technology behind the financial planning software. And they look at cash flow management. They look at other risks that are out there. They look at what you're spending, your budget. They look at taxes. Obviously, taxes are important, and that spits out a framework, right? But then it comes back down to the human element. Somebody's got to be able to look at those numbers, make sure they make sense. Where are the errors? Where are the things we have to be cautious of? But yeah, you can't do it anymore without technology.
Yeah, yeah. I guess maybe that's what came to mind as you were talking about these things. It's I would imagine in your career you've done well for a long time, so you have basically like you've seen probably like virtually no use of technology now to the point of having AI be at least available. I'm not sure that we're not at the point where it can take away all the human elements yet, but I would think that you've had to have some adaptation through your career just to be kind of on top of whatever new is coming through the pipeline and continue to serve clients the best. So I would imagine you've seen. I would think, I don't know enough about it, I guess, but I would think like financial service industry is oftentimes on the forefront of some of that technology and how it can be implemented.
Yeah, it is. I mean, you're heavily regulated, so a lot of the stuff that's out there is really interesting is not in our, pipeline yet. We don't have access to it. But I mean, gosh, I hate to date myself, but when I go back to when I first started, when you bought a stock trade as a paper ticket, you took it back to the office and sent a vacuum tube to process the stock trade, right?
Right.
You didn't have you had computers, but your client management system was on a Rolodex, right?
Yeah.
And so, go from that till now and just think of how it's just changed, or stuff on your iPhone versus 15 years ago, 16 years ago, you didn't have an iPhone. So we're definitely seeing a lot of those changes, but it is, and again, because we're regulated, some of the stuff isn't available yet, but they're definitely coming in this direction. But when I do a client meeting, it's being recorded by AI, and AI then summarizes all my notes. And so what I used to have to go back after a meeting and kind of type in everything we talked about and set my task, now AI does it in 10 minutes. When I look to analyze a portfolio, like we just talked about, now we're not using the AI software behind it, but Aladdin's using the AI software behind it to run all these different scenarios for you, and then using AI to kind of summarize it and give you a printout that takes, like I said, 20 minutes. We just take a couple weeks, or we'll throw something into ChatGPT or Claude and have them look at the spreadsheet we just created for analyzing clients' information, and have them build it out, look for errors. And then obviously we look at their stuff for errors because it's not perfect yet, right? But all those things have really helped us manage portfolios better, helped us manage the client allocation better. And it's just getting better. It's just because of security issues and regulations, they got to get vetted first. But the stuff that's coming down the pipeline is really interesting.
Yeah. What sort of asset classes are we talking kind of all securities, or are you also working, real estate, crypto, whatever other asset classes do you advise people with?
Yeah, for the most part, securities, stocks and bonds, right? We get the crypto question all the time, and we haven't been a big adopter of crypto, partly because I don't understand. I mean, I understand enough to be dangerous, like I said earlier, but I don't understand it enough to put my clients into it. Yeah, it's one of those things where I don't know how you can determine a value, right?
Mhm.
because it doesn't have earnings, it doesn't have, other than what someone else to pay for it. That's what the value of crypto is. And so when clients ask me, it's like Bitcoin a good buy at 64,000. I'm like, I have no idea because I don't know what the next person wants to pay for it. I can't look at the
Yeah.
earnings or the valuation for it. So we do, like I said, we don't buy the crypto by itself. We've got a couple. I mean, I'm talking a couple of clients that have been interested in it that bought the IBIT, the index, but nothing that we've actually managed with like a crypto wallet. We do some real estate. Real estate's been tough right now for the investment portfolios. Not actually going out and buying a building, right? We're
Right.
doing it through managed portfolios, and real estate's been in a tough market. So, we've actually, when we do our analysis, real estate is actually one of the most expensive sectors in the market right now. So we've actually backed off of real estate. But we do know real estate long term is one of the best asset classes you can own. It increases your return, reduces your risk, but we just don't see it as an entry point right now. So for the most part, 95% of our portfolios is stocks, bonds, you know, some of the different, hedging bond strategies, different hedging stock strategies, but it's mostly just, the basics.
Yeah. Yeah. I mean, and I think that's kind of the point, right? That's kind of the point of what you do is to be able to speak about all those things to your clients with those perspective. And it's like, oh, maybe, someone really interested in crypto. Okay, fine, do that. But,
Yeah.
I'm not the person to advise you on that, or, that sort of thing. So I think that's, it makes a lot of sense to just if you're running those analytics and you're saying, this is what I think makes sense. I think, as someone who invests in real estate, I sort of agree with you right now. I love real estate as an asset class, but right now is a tough time to decide what to do about it even. And so, I think that's the whole point. That's the whole point of having someone, kind of advise you on these sorts of things.
Like you, I love real estate as an asset class. It's like, for me, it's like a three-legged stool where you're gonna have, stocks and bonds and real estate, right? And we're in the process of, knock on wood, buying a building for our office. Because with the new big beautiful bill with the tax write-off for the cost segregation analysis, it's, you get a big benefit. The government's kind of a side investor for you, but is it financially make sense right now in this current market for what's out there? I'm not sure, but it's just something you have to evaluate.
Yeah, exactly. It's what what works and what's my strategy and all of that. I think you said it before, speaking when I asked you, your strategies, it is really like individual on a per client basis. So
Yeah.
makes a ton of sense. Well, Chad, let me switch gears. I want to make sure I ask you the questions I ask every guest. The first one is just based on the name of the show being Know Your Why. So, we talked about, kind of the entry into the industry that you're in. We talked about kind of the putting in your 10,000 hours and that takes time. But at this point, I mean, you've been successful in it for a long time. You've owned your own firm. What's driving you? What's kind of, the why behind further success?
Yeah, I kind of like building things. What I'm saying? Like, in the 4 years that we left and started actually almost 5 years now, we left and started Seapoint. We were at $215 million of assets we manage. Now we're close to 400 million. For myself personally, then we've now added. We kind of take a step back. When I left and joined started Seapoint, it's just myself and my assistant Sarah. So the two of us.
Mm-hmm.
Now we're almost 5 years in. We have 6 other advisors have now joined us that work under our Seapoint umbrella. As a team, I think we're about 650 million of assets that we manage as a group. And we have another advisor joining us here in another 3 months. So we'll keep growing that and building out the brand. I love, building, clients' portfolios and building them wealth and building out their asset strategy to where they can retire how they want to. So I just like the, even for, myself, building a business, right? So I think it's just, taking something and building it to what your vision is right? And I just enjoy that.
Yeah. No. Right. Yeah. Success helps that feel feel good. No, that's great. That makes a lot of sense to me. Well, when people hear this and they want to connect with you, what's the best way for them to reach out? Prospective clients or otherwise?
If somebody wants kind of more confidence on what they're doing, I'd say, we set up maybe a 25, 30-minute phone call to kind of get introduced to each other and see if we can help, right? We got to be able to add value to what, they're trying to accomplish. Otherwise, what we're doing doesn't make sense for them to, pay our fee for that. But the best way is to, either, go to our website, which is seapointwealth.com, which has information about our company and a way to contact us, or shoot me an email at chad@seapointwealth.com, which comes directly to me. And I have a scheduling link on that when I respond. I'll schedule a link and we can schedule a 15, 20-minute phone call to kind of go through what you're looking for and what you're trying to accomplish.
Okay, perfect. Well, we'll definitely make sure we put that in the show notes so people can find you easily. Chad, I've really enjoyed this conversation. Thank you so much for this. I think, from a theme perspective, obviously, financial management, wealth management, all of that is tremendously important for family and legacy and everything. But I love that we talked about kind of just what it actually takes to kind of get to a level of expertise in realistically you could apply it probably to any field, but the time and the effort that you put in. So thanks for being here and sharing what you did. I really enjoyed it.
Yeah, thank you. No, I've enjoyed the conversation as well.
Well, folks listening, make sure you connect with Chad and please like, rate, and review the show so we can continue to get great guests. And as always, thank you so much for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?